All right, welcome to the explainer. If you've ever stared at a rapidly moving stock chart, seen those flashing red and green numbers, and felt like you were trying to read some kind of alien language, well, you are in exactly the right place. Today, we're decoding the stock market completely from the ground up. Whether you're an absolute beginner just looking to make a little extra pocket money from the couch, or you're just super curious about how people actually make those massive returns you're always hearing about, we're going to break it all down. We're stripping away all that intimidation and translating that heavy financial jargon into real, clear, actionable concepts. Okay, let's dive right into this scaffolding approach. We're going to build your knowledge up step by step. First, we'll cover what trading actually is, then we'll compare delivery versus intraday trading. After that, we'll tackle understanding options, break down calls, puts, and expiry, and wrap up with exactly how you can get started safely. All right, section 1, what is trading? Let's get right into the absolute basics. Now, before you even think about opening a brokerage account or stressing over a chart, you got to ask yourself the most fundamental question. What exactly is trading? People throw this word around all the time, but let's look at what it literally means in the real world. At its core, it's actually incredibly simple. Just think of it like flipping a physical item. Say you buy a rare limited edition pair of sneakers. You hold on to them, wait for the hype and demand to go up, and then you sell them to someone else for a much higher price. The only difference here in the stock market, instead of a pair of shoes, you're buying digital shares of companies, like Reliance, SBI, or Zomato. You're just buying an asset, waiting for a price change, and executing a sale. That's the whole shebang. And this brilliantly illustrates the simple math of the market. Let's say you buy a single share of a company for 100 rupees. You wait a bit, the price shoots up to 120, and you decide to sell. Boom, congratulations, you just pocketed a cool 20 rupee profit. But, it goes both ways. Say you buy at 100, but then some terrible news breaks and the share price tanks to 80. You might get nervous that it's going to crash all the way down to 50, so you sell right then and there to stop the bleeding. In that scenario, you've locked in a 20 rupee loss. Buy low, sell high for a profit. Buy high, sell low for a loss. That is literally the essence of trading. Moving right along to section 2, delivery versus intraday trading. So when you open up your app to actually buy a share, you're going to see two primary methods. First up is delivery trading. This is the traditional investing that most people think of. You pay the full price for the share. If it costs 10 rupees, you pay 10 rupees. And the beauty of delivery is that you take actual delivery of the stock into your account. You can hold it for as long as you want. 1 day, 1 year, 10 years, totally up to you. You can just wait patiently for that price to rise. But then there's intraday trading. Now, intra literally means within the day. And here, your broker actually gives you something called 5x leverage. That means things are essentially 5 times cheaper for you up front. So that same 10 rupee share, it's only going to cost you 2 rupees out of pocket to control. Sounds absolutely amazing, right? Like a massive cheat code discount? But hold your horses, because this massive discount comes with a very strict condition. And that condition is time. The Indian stock market opens at 9:15 a.m. and closes exactly at 3:30 p.m. Monday through Friday. If you use that intraday option to snag the 5x discount, you absolutely must sell that share the exact same day. If you get distracted, go to lunch, and forget to manually sell by 3:30 p.m., your broker's system isn't going to wait around. It will step in and automatically sell them for you at whatever the current price is right at the buzzer. Whether you're riding a massive 5x profit or sitting on a huge 5x loss, that trade is forcefully closed. Intraday is fast, and it requires your absolute undivided attention. Which perfectly leads us into section 3, understanding options trading. Now, you might be wondering, if a normal stock only moves maybe 1 or 2% in a given day, how on earth are people making those crazy rapid daily profits you see flexed online? Because let's be real, no one is getting rich overnight on a 1% move. Well, the answer is futures and options, usually just called F&O. And guys, it is an entirely different beast. First off, you aren't actually buying shares of a specific company anymore. Instead, you're buying something called a premium. Second, instead of looking at one single company, you're trading on the overall performance of massive market indices. Think the Nifty 50, which groups India's 50 biggest companies, or the Sensex, which groups the top 30. If the majority of those heavy hitters do well, the index goes up. If they bomb, the index goes down. And third, everything happens at lightning speed. Traders here aren't looking at yearly charts. They're glued to charts where every single blip of data represents just 1 minute or 5 minutes of time. To actually read those hyper-fast charts, you have to understand the basic visual language of the market, candlesticks. And honestly, it's super simple once you get the hang of it. Seeing a green candle, that means the market is going up. The overall index number is climbing. Seeing a red candle, the market is going down, and the index number is dropping. When you're trading options, your entire job, literally your only goal, is to look at these candles, maybe use a few indicators, and accurately predict whether the next few candles are going to be green or red. Let's see how you actually pull that off in Section 4, Calls, Puts, and Expiry. Okay, so you've made your prediction about the market direction. How do you actually cash in on it? The golden rule of options is super straightforward. If you predict the market is going to go up, meaning you're banking on green candles, you need to buy a call option. If the market actually goes up like you thought, the value of your call premium skyrockets and you profit. But here's the really wild part about options. What if the market is totally crashing? What if you expect a sea of red candles? Well, you can still make money. If you predict the market is going down, you just flip your strategy and buy a put option. If the market keeps falling, the value of your put premium actually increases, securing you a profit on the way down. So write this down: calls are for green, puts are for red. But before you run off to load up on calls and puts, we absolutely must talk about the ultimate risk factor here. Remember how delivery stocks can just sit safely in your account for a decade? Yeah, options cannot do that. Every single option premium has an expiry date. It might be today, it might be next Thursday, but as that expiry clock ticks down, the premium naturally decays. If the market doesn't make that big move you confidently predicted by 3:30 p.m. on the day it expires, the value of that premium doesn't just dip a little bit, it can literally go to absolute zero. Zip. Zilch. Your entire investment in that specific trade can evaporate in an instant. It requires surgical precision. So, how do we survive that kind of risk? Let's talk about it in Section 5, Getting Started Safely. Because options trading literally carries the risk of your premiums dropping to zero, you need accurate guidance. How do you find it without losing your shirt? Well, first, we have to talk about exactly what not to do. The internet is absolutely flooded with random social media pages and sketchy Telegram groups promising you guaranteed call or put tips. Let me be incredibly clear here. Straight from the industry experts, these are overwhelmingly fake. They're just traps designed to trick beginners. If you blindly follow random Telegram tips, you are practically guaranteeing yourself a massive loss. Just don't fall for them. You need real, verified, registered professionals. So where do you actually find these real experts? You find them right inside your verified brokerage apps. For instance, if you open up an app like Angel One, you can navigate right to a section called Pro Insight. You aren't dealing with random people on the internet here. These are SEBI-registered experts. SEBI is basically the strict referee of the whole Indian stock market. Inside this section, you can actually see the transparent track records of these experts. We're talking hard data. You can see an expert who has maintained a 73% or even a crazy 95% accuracy rate over the last few months. And honestly, the absolute best part, you don't even have to blindly trust them right away. You can usually grab a 7-day free trial. This lets you sit back, watch their call and put recommendations in real time, test their accuracy with fake paper money, and actually learn their strategies safely before you ever commit a single rupee of your own capital. Wow, okay, we've covered a massive amount of ground today. We started with the basic everyday math of buying and selling, explored the huge differences between patient delivery holding and that fast-paced intraday leverage, and finally pulled back the curtain on the high-risk, high-reward world of options, calls, puts, and expiry dates. You now possess the foundational blueprint for all of this. So I'm going to leave you with this final provocative thought. Now that you actually know the rules of the game and you know exactly how to find verified SEBI-registered advice, what is your next step going to be? Will your very first move be patiently buying a safe, reliable delivery stock to hold for the future? Or are you ready to test the waters with a calculated option trade? The choice and the opportunity is entirely yours. Keep learning, stay focused out there, and I'll see you in the next explainer.